Okay, let's unpack this. Welcome back to the deep dive. This is where we extract the most important insights from mountains of financial data so that you get the shortcut to being well informed.
And today we are really tearing into something interesting. The Q3 2025 earnings call for Teledyne, ticker TDY.
Yeah, this deep dive is, I think, tailor-made for anyone trying to understand the current investor mindset.
Absolutely.
Because what happened with Teledyne, it just perfectly captures the market's extreme focus on, short-term noise.
It really does. Management delivered a classic beat and raise.
Incredible financials, raised full-year guidance.
And the stock immediately sold off.
So our mission is to understand that precise, critical divergence. Why did the market look at a textbook success story and just instantly hit the sell button?
Well, it was a truly exceptional quarter, man, just in terms of sheer numbers. We have to start there to appreciate the scale of the paradox.
Okay.
Teledyne posted $1,539.5 million in quarterly sales, which represented solid 6.7% growth compared to the same period last year.
Okay, so a strong top line. What about profits?
On the profit side, they definitely outperformed expectations. Non-GAAP adjusted earnings per share landed at $5.57.
And that was a beat, right?
A beat over the street consensus by about 10 cents, so nearly 2%. And what's really crucial here, the engine room of the business cash flow was phenomenal.
Mm-hmm.
They generated $313.9 million in free cash flow, which is a benchmark for the company. They also noted, superior growth in total company new orders, driven significantly by that expanding backlog at Teledyne FLIR.
So, okay, rising sales, better than expected profits, robust cash flow, and a commitment to a higher full-year target. That sounds like a company that's firing on all cylinders.
It does.
But you pointed out the immediate acute skepticism. Intraday, shares traded down despite all the success. It's clear the investment community wasn't interested in celebrating the past 3 months. They were entirely focused on the future and specifically the risks they saw lurking in Q4.
That is the core tension we have to explore.
Yeah.
And to understand the momentum they're building, we really have to look segment by segment.
Okay.
Because the growth wasn't uniform. It was concentrated in these specialized, high-demand areas.
So where should we start?
Let's start with aerospace and defense electronics. Sales in this segment shot up a massive 37.6% year over year.
Wow.
Now, a big driver there, about $69 million of it, came from recent acquisitions.
Right.
This confirms their M&A strategy is immediately adding to the top line. Segment operating profit also increased, although if you look closely, the segment margins dipped slightly.
Okay, and why was that?
It's an important detail. The acquired businesses came with comparatively lower margins, which just dragged the segment average down a little from Teledyne's usual high baseline.
Right, and that's the Teledyne story in a nutshell, isn't it? Buy strategically, accept an initial margin dilution, and then just optimize it later.
That's the playbook.
But beyond the acquisitions, where was the pure organic strength really showing up?
The underlying organic muscle was strongest in the long-cycle businesses.
Mm-hmm.
If you look at instrumentation, sales there were up 3.9%.
Okay.
And this was powered by specific areas like marine instruments, think critical interconnects for the offshore energy market, and components for the U.S. Navy's strategic Virginia and Columbia-class submarine programs.
Right. Big ticket, long-term stuff.
Exactly. They also saw a nice growth in environmental instruments, which was driven by higher demand for things like process gas safety monitoring and ambient air monitoring.
And that was tied to new power plants.
Yeah, partly fueled by the construction demand for new natural gas power plants.
So specialized defense and these stabilizing energy markets are really acting as structural anchors for the whole portfolio. That's resilience. What about digital imaging, the DI segment? That one's often been under a microscope.
Yeah, DI sales were up a more modest 2.2%. However, there was a key nugget of positive news here. This was the first, and even there, the operating margin actually improved sequentially.
Now, let's zoom out to the total margin picture, because this is where the market often gets nervous, and it's critical to our divergence thesis. We saw the overall non-GAAP operating margin tick down slightly to 22.1%.
Yep, a drop of about 40 basis points year over year.
Right, so a 0.4% dip. On the surface, that looks like margin compression, which is usually a red flag. But you're flagging this as a strategic choice, not a sign of weakness. Why is that?
Precisely. They are deliberately stepping on the gas with internal investment. They're trading short-term margin for long-term technological dominance.
So they're spending money to make money later.
Exactly. Management pointed to two major factors for the dip: consolidation costs from integrating mergers and, critically, greater R&D expenditure. They're channeling that substantial cash flow into future-proofing their tech platform.
And we're not just talking about minor upgrades here, are we? What specific investments are they making that they believe justifies this short-term hit?
They are definitely targeting the high end. They mentioned significant R&D going into next-generation sensors for the semiconductor space, aimed at the most advanced chip manufacturing. And also high-end oscilloscopes, which are really specialized testing equipment. These are big-ticket, high-margin products down the road. They are actively choosing to spend cash now for much higher returns and a structural competitive advantage later.
That's fine in principle, investing for the future, but how much pressure is there on them to deliver these returns? When do these R&D efforts actually start hitting the revenue line? Is the market willing to wait?
Well, that's the crux of the debate, isn't it?
Yeah.
They're operating on a multi-year horizon. While DI growth was modest this quarter, the management team highlighted that the strategic R&D is aimed at catching the next wave of technological inspection standards.
So they're playing the long game.
They are betting that the near-term margin dip is just a small price to pay to secure market dominance 5 years from now. It really reinforces the idea that this isn't a company focused on quarter-to-quarter wins, but on structural market positioning.
Okay, so we've covered the financial beat, we've covered the strategic investment context. Now let's tackle the raise and, crucially, the fear factor that caused the sell-off. What did the guidance actually look like?
They absolutely raised the bar. Management elevated their full-year FY25 non-GAAP EPS outlook to a range of $21.45 to $21.60.
Okay, that's strong.
Their Q4 outlook was set at $5.73 to $5.88. That is a clear signal of continued underlying momentum.
Okay.
However, this is precisely where the divergence began. They raised guidance, but immediately coupled it with what they called a measured near-term view. And that caution was exclusively due to the one factor nobody can control: the ongoing U.S. government shutdown.
And that single piece of political theater in Washington is apparently enough to sour all those excellent results.
Yeah.
How deep does that risk really cut for a company like Teledyne?
Well, it acts like a massive administrative brake on the whole system.
It's not a demand problem, then.
No, it's not that the demand disappears, but the pipeline just freezes. They can't get new contract awards signed, they can't get export licenses approved for international shipping, and cash collections from the government slow to a crawl.
So what's the worst-case scenario they laid out?
Management was very transparent.
Yeah.
They said, look, if this shutdown drags out for months, it could potentially affect about 25% of their total sales.
Wow, 25%. You're putting a quarter of your business on pause.
Yeah,
That's why the market reacted so violently. That risk is visceral.
it is.
But is this a structural demand problem, or is it simply a timing and bureaucratic issue?
It is absolutely a timing issue. They provided mitigating context, too.
Yeah.
During the 2018-2019 shutdowns, which lasted over a month, they didn't see a significant impact because their backlog is so robust.
Right.
Their belief is that the strong, diversified portfolio across defense, energy, and instrumentation protects them from this kind of temporary political turbulence. It's a traffic jam, not a road closure.
And we should briefly note, they addressed another piece of geopolitical friction: the minimal impact of China designating Teledyne FLIR as an unreliable entity.
Right, a total non-issue, effectively. Management pointed out that sales to customers in China by Teledyne FLIR were less than 0.4% of total sales.
Barely a rounding error.
Absolutely. The short-term risk is entirely administrative. The structural drivers, on the other hand, are massive and multi-years. So let's synthesize the why it matters for you, the long-term investor.
Okay, lay it out.
First, their M&A strategy is alive and well. They're focused on these corporate carve-outs.
Right, buying a specialized division from a bigger company.
Exactly, which they excel at. This is their 12th one. They announced the pending acquisition of Saabs TransponderTech, expected to close in Q4.
So why is this TransponderTech deal so strategic for them?
It expands their maritime and airborne communications capabilities, specifically in areas like AI and VDES. And this is hugely important because it enables cross-selling opportunities directly into FLIR's defense channels.
So it strengthens the FLIR acquisition.
It plugs an immediate hole in their portfolio and strengthens the integration of the FLIR assets.
Yes. So they buy smart, and then they have this massive organic defense pipeline just waiting to absorb those new technologies. Tell us more about the backlog. What key programs are driving that 500 million plus in unmanned systems revenue?
The backlog is immense, and it's driven by specific formalized programs. Management stated they are now around $500 million in unmanned systems revenue.
And that's up from before, right?
That's up from the $450 million they discussed previously, and they expect this to grow across air, ground, and underwater unmanned systems.
500 million in unmanned systems alone. That's significant visibility. What are the specific opportunities waiting for Washington to unlock them?
The two biggest near-term contracts are the full-rate production order for the Rogue 1 loitering munition under the Marine Corps OPFL program,
Okay.
and the potential award under the U.S. Army's LASSO program. These are tens of millions of dollars in near-term contracts, just waiting for the government to fully open its doors.
And what are these programs exactly?
Rogue 1 is a lightweight, tube-launched drone used by small units. LASSO is the broader program focused on rapidly deploying loitering munitions across the force. We also heard about major growth in the subsea domain. Subsea gliders and AUVs, essential for mine countermeasures.
Driven by what's happening in places like the Black Sea and the Asia Pacific.
Exactly. The geopolitical demand is intense.
That long cycle visibility is astonishing. And it seems the geopolitical tailwind isn't just a U.S. phenomenon, which gives them more insulation from Washington's gridlock.
That's a great point. Management expressed really strong conviction regarding the European defense market. They point out they have 5,100 employees in Europe and currently generate about $500 million in military sales in the region. They are betting on this increasing significantly due to rising geopolitical pressures and the huge push among NATO allies for in-country production.
A trend where Teledyne is extremely well positioned.
Perfectly positioned.
So we circle back to the divergence. We have management reinforcing their execution credibility, showing off a strong balance sheet with leverage at a disciplined 1.4 times, and raising the full-year target based on real structural momentum.
And the market.
The market, however, focused entirely on the immediate transient Q4 risk posed by the U.S. government. It's a bet on short-term administrative noise versus multi-year structural momentum.
Which brings us to our final segment, where we set the stage for the outrageous but plausible trade pitch. And remember, this is an analysis of the sources. It should never be construed as personalized financial advice.
The disclaimer is noted.
The core thesis here is really simple. The market sold off on government funding risk. That risk is temporary.
But the drivers are not.
The structural drivers, European defense rearmament, the burgeoning 500 million plus unmanned systems backlog, marine strength, and that disciplined M&A playbook, those are multi-year growth engines.
So the market is essentially handing you a gift then in the form of a discount driven by non-fundamental factors.
Precisely. The trade idea here is a long-term defense portfolio anchor.
Okay.
Buy shares immediately post-sell-off, specifically targeting a return to the pre-call valuation based on the raised full-year EPS guidance.
That seems plausible, but what's the outrageous element? How quickly are we betting this discount evaporates?
The outrageous element is betting that macro geopolitical forces will overpower the short-term fiscal uncertainty and do it immediately.
Okay, so what are the catalysts?
We're banking on two near-term catalysts to snap the stock back. First, the closing of the TransponderTech acquisition in Q4 will reinforce their M&A execution.
Second, the imminent formal award for those Marine Corps and Army unmanned systems contracts, which will follow as soon as the funding stabilizes, will force analysts to shift focus back to the massive, sticky backlog. So it's a bet on the long-term, high-quality structure overwhelming the temporary Washington gridlock.
That's the bet.
That's a bold pitch, but it's rooted deeply in the facts presented in this call. Okay, let's wrap this deep dive up. Teledyne delivered a solid beat and raise backed by phenomenal cash flow and a massive, clearly visible defense backlog.
Like it.
But near-term sentiment was absolutely poisoned by the potential for delays associated with the U.S. government shutdown, specifically affecting the timing of contracts.
Yeah, and the final thought is about timing and value. The market is trading a long-cycle, specialized industrial defense titan like Teledyne as if it were some high-flying, quarter-to-quarter growth stock.
When it's not.
It's not. Management stressed that diversification, defense, energy, scientific instruments acts as a fundamental protective layer. The sell-off suggests the market completely ignored that long-term resilience and instead chose to penalize them for Washington's gridlock.
So the final question is,
Is the price of political uncertainty simply too high right now? Or is this the perfect opportunity to buy generational technology at a temporary administrative discount?
An excellent point. Something for you to mull over as you process these numbers. As always, the information shared here is based purely on our analysis of the earnings call and sources. It is not, and it will never be, personalized financial advice.
If you're looking for tailored investment advice, please consult a qualified financial professional.
Thanks for diving deep with us. We'll catch you next time.